Thanks. I think by now you should be pretty familiar with me because I get to come on the stage, be the guest question, Q&A answer, with every session. So that's the prerogative of being vice chairman. You get to invite yourself up to stage after every session. I am responsible for the strategic M&A and investments of the company. So that's why I'm here to talk about our strategic activities, M&A activities, as well as capital allocation, since the spending of dollars into strategic assets is a big capital allocation related decision. I was thinking about how I present this particular segment. But after seeing the presentation of all of our businesses today, I think there's a common theme that goes through all of them, which is that all of our business units fit together pretty well through the data platform, through the common consumers that we're serving, through the uniform identity of those consumers. So I was thinking that maybe this is a more difficult slide to explain. Now I don't think it's going to be that difficult. Think of strategic investments and M&A as playing a game of Go, okay? In the game of Go, the objective is to put the pieces on the board, on the chessboard, and surround your opponent eventually. But you can start anywhere on the chessboard, and you can finish anywhere on the chessboard. You could be, in one move, you could be in the northwest corner of the chessboard. In the next move, you can be in the southeast corner of the chessboard. You can be all over the map. And I think from the perspective of an investor, it must be very, very frustrating to look at how we how we are making these chess or Go moves when we make strategic M&A and acquisitions. Because we may not, for competitive reasons, we may not always fully explain which direction we're going. But you have to understand that we're playing a game of Go here when it comes to putting the right assets in the right place. And the one thing that I'd like everybody to remember is what's the purpose of making M&A and investments. The purpose is to build long-term value for Alibaba, okay? So in every transaction we do, we ask ourselves, at some point down the road, is it maybe next quarter or maybe next 3 years from now or 10 years from now, is this asset going to add to the overall value of our business? And later on, I would explain the only way to add value is through synergies, to create sort of chemistry effects between the assets that you acquire and the businesses that we own. So in this game of Go, making M&A and investments, what we're really looking at is that the assets on the board it's not a linear thinking process. It's not like, okay, I've acquired the video business. Next thing, I'm going to go acquire a movie maker and so on and so forth. The assets on the board are networked. What does that mean? It means that you may have an apparent reason to acquire an asset. Like we bought Youku. Why? Because we want to get into the online video business. Why is that? Because we want to serve more consumers and because we think that's an extension of consumption, right? But in the back end, there's also a network effect when these assets come into the family through the contribution of data through better understanding of the users. So what we do is that we need to make sure that when the assets come into the family, that they create chemistry effects with the rest of our business. And when people ask me, Joe, what's your M&A strategy? My answer is, I have no M&A strategy. Okay, as the head of M&A, I have no M&A strategy. My M&A strategy always follows our business strategy. Okay, and so I have to talk to Daniel, our CEO. I have to talk to the heads of all of our business units. I have a team of people that talk to them all the time, day in and day out, to really understand where they're going strategically, what they're thinking. The other thing that drives our M&A strategy is we have to be very aware of the future technology and trends, user trends, product trends, what's going on out there, so that they can feed back to our own business and inform us as to, we have to make some judgments as to which directions we need to sort of aim our a gun, if you will. I'm going to use an analogy in sort of describing my work. Think of Daniel, our CEO, and also our business unit heads as the chef in the kitchen. They are the Michelin-starred chef. They're making great dishes in the kitchen. But in order to make good dishes, they need ingredients. And they say to me, Joe, I need this ingredient. I need you to go out and find the best ingredient in this category and bring it back. So what I do is I go out to the supermarket, I go out to the farmer's market, I go out to the wet market and scour the earth to look at the most proper ingredient so that I can bring it back into the kitchen for our chefs to make. And guess what? During the cooking process, chemistry effects happen. That brings me to the importance of integration. Every time we make a strategic acquisition or even an investment, some degree of integration is key. We need to focus on synergies within Alibaba, between the investee company or the acquired company with Alibaba. That's actually a not very easy process. It requires a lot of planning. And that's why in the process of making an investment or an acquisition, we need to get a business owner to also own the project. It doesn't matter if I'm sponsoring the investment, I really like it. I can't independently go out to the market and say, oh, I like this fish, I'll bring it back if the chef didn't order it. That's not right. So some business owner within a business unit or the CEO must sponsor a transaction that we do. And the other thing I want to say is that the success or failure of a acquired business very much depends on the people. Whether it's the people that we bring in and retain them, or it's the business unit people that come and sponsor the transaction. To give you an example, several years back, we acquired the UC Web business. And we were fortunate to have not just acquired a business, but also the people, the management team. Yu Yongfu, who was presenting the digital media and entertainment segment, came from that acquisition. And he actually helped us integrate himself into Alibaba. And then he went on to help us integrate some of the other assets we acquired. So the people, very, very important. And you also need to bring in innovation. Synergies don't just happen. Synergies, you can't hire a McKinsey consultant on a piece of paper and say, here's the synergy, let's do it. They require a little bit of change in in the thinking, change in the product, or change in how the acquired business's workflow works in order to be integrated into our operations and create synergies. And the final thing I want to say about integration is that the outcomes are likely binary. In other words, there's no such thing as a so-so acquisition. They either are wildly successful or they fail and we have to write down the asset. And that's why it's so important for us in terms of looking at deals, in looking at M&A, to plan for the eventual integration and have the people ready and committed to the integration. Okay, let's talk about some of the strategic goals why we do M&A transactions. And we have a representative spread of some of the companies that we have acquired or have invested in. We've always said that improving customer experience is one of our major strategic goals. So as you can see, every single one of our acquisition or investments, have the effect of improving the customer experience, whether it is adding more elements of a new dimension on the data about the user, or improving the logistics experience. That's a primary reason why we do M&A. The second reason is user acquisition. We were, I would say 5 years ago, we were more of a vertical company in the e-commerce business. But then we acquired UCWeb, a mobile browser business. We acquired AutoNavi, a mapping business. And we acquired Youku, online video. So with that, the acquisitions come with new users, new customers, potential customers for e-commerce. So in the earlier session, Yongfu talked about the two circles, and then there's some overlap. But then there's the space where things don't overlap. That's new user acquisition. And the third reason is geographic expansion. We have made investments in Lazada for Southeast Asia. We have made investments in India to expand our product and services into these regions. And finally, the new thing that we talk about quite a bit in this setting, as well as things that we have been thinking about for the last year or so, is the whole idea of new retail. People often ask me, well, why do you sometimes, instead of just making an acquisition, just buy the company? Why do you make a minority investment instead of just buying the whole company? Well, there's some reasons why, especially in the China context. It's very, very difficult to buy an entire company. If someone was willing to sell the entire company to you, you have to wonder, what's wrong with the business? So we have taken a phased-in approach with respect to some of the best assets that we have acquired. Again, I don't want to bore you to death, but example, UCWeb started with about 8 years ago with a 15% investment into the company, and then we phased in over 2 stages, buying up to 2/3 of the company, keeping management in place so that they continue to be incentivized along with the metrics of that business, and then later on, fully acquiring that company. So keeping management aligned, interest aligned with the asset that's coming into the family is a reason why sometimes we don't buy the whole thing. Another reason is some of the investments that we make have high strategic value to us, but it is just not our core, okay? It's not what we do, and so we would make a significant minority investment and have and establish a very strong relationship, both formal and informal. Formal meaning commercial contracts and whatever with the investee company. Informal meaning we got to know the management team or the founding team really well and be friends with them. So when we sit down and talk about strategic collaboration, that's an easy conversation. The third reason why we might not acquire the whole company but partially go in is that we see some risks potentially in the business or in our ability to integrate. Most of the time, it's actually our own ability to integrate. We have to be humble about this. If we don't see that ability in place, we'd rather make a minority investment first and then see how things develop and then make the full-blown acquisition. The case of Lazada, for example, we acquired 51% stake in that business. At the time, our thinking was, gee, we really like this business, great for international expansion. We'd like to tap into the Southeast Asian market, but do we have the ability to really fully integrate them? Let's wait. Let's wait to see how the management team of Lazada works with us. And that's an example of that scenario. And we will be, I think once we've spent time together with the management team of the business that we invest in, we may take the next step to fully acquire them. I want to talk about valuation a little bit. How do we think about valuation in the M&A and investment market? The first part of the process is someone comes, or we go to someone and say, hey, we want to make an offer to buy your business, and they give us a price. And the price is usually much higher than what we're willing to pay. So you go through a process of negotiating the price. But how do you negotiate the price? You negotiate the price through a valuation discussion. The valuation discussion is fairly objective because you can look at comparable companies, you can look at market trading comps, you can do a DCF, you could sort of use all the traditional financial metrics to have a valuation discussion. And in that process, reduce the seller's expectations. While we go through that valuation process, what we're really thinking about is a lot of work goes into, well, what is the real value that this acquisition will deliver to us? That's really what we, in the background, focus on during the process. And this is how what we go through in every single M&A and investment that we do. In the next few slides, what I want to go over is to give you somewhat of a report card. Since Maggie yesterday gave a report card of the whole business, and me, I'll just give you a smaller report card of the area that I oversee. Over the last 2 years, we've invested about $21 billion of the company's capital in a number of companies, businesses. If you look at it, it's actually been fairly concentrated. About 75% of the capital have been invested in a few very key strategic initiatives, including digital media and entertainment, including international expansion, including logistics, including getting into the O2O space, and be more of a player in the whole sort of local services. So all told, our approach is not very scattered. Our approach is actually very, very concentrated and very, very focused. And I don't really need to go into a lot of detail to explain to you why Youku is important, why Lazada is important, because the presentation in the last 2 days have pretty much explained that unifying theme, in why we do certain things. So that's just a report card of how we have utilized the company's capital, and as shareholders, it's your capital as well. The next thing I want to talk about is some of the minority investments that we have made, because people always say, well, this thing, you kind of made a minority investment. Is it really strategic? How are things doing? Well, I'm pretty happy to report that our largest minority investments over the years have returned more than 4 times the original cash cost. And we've laid out, I'm not going to go into the details, but we've laid out all the numbers here. We spent about $4 billion in, 7 different investments. And today, they have a market value of $18.2 billion. If I ever go into the private equity business, I would probably put this chart up as my track record. No, just kidding. Now, there's one thing that I'd like you to understand. There's a cash cost, and then there's the balance sheet carrying value. We have done a few things where, on an accounting basis, we had to adjust the carrying value on our balance sheet. So a case in point is Alibaba Pictures. We spent about $700 million buying into this company that we used to control. And then through a financing transaction, bringing in outside shareholders, we deconsolidated the transaction. So actually, what happened 2 years ago was, upon that deconsolidation, we had to book an accounting gain, a non-cash paper gain. We didn't want to do that. It was silly to book, it was something like a $3 billion accounting gain. But of course, we had to follow US GAAP, so we had to book the gain. So the carrying value gets written up. Today, the stock market price of that investment is below the carrying value, but we're not worried about it, but because on an aggregate basis, number one, on an aggregate basis, our minority investments have done quite well. And number two, we're still way above water when it comes to the cash costs that we put into the business. Finally, this is the other aspect of capital allocation. What we have done with our capital structure and the cash on our balance sheet. As you all know, in the last quarter earnings announcement, we announced that the board has authorized a $6 billion stock buyback program over the next 2 years. This is a continuation of the buyback authorization and the buyback activities that we have done over the last 2 years. So in the last 2 years, calendar 2015 and 2016, we've bought back a total of about $5.1 billion of stock, $5.1 billion being the cost to us of buying back those shares. It equates to about 3 percentage points of our outstanding shares. And today, the value of the stock that we bought back today is $9.2 billion based on the market price of June 7th. Not June 8th, June 7th. So we've created value. We created accretion to our shareholders, and we created value if you just look at the asset that we bought back and what it was worth back then and what it's worth now. And pretty much that's my report card to you. And with that, I think Jack is up.
Thank you very much, Joe. That was wonderful.